Mm. Good morning, everyone. Welcome to the Guided by Corner webinar series. My name is Andrew Batshaw. I'm the Director of Client Services for Corner Property Management in Pennsylvania, and I will be your moderator today. We are thrilled to have you join us for this session. The name of this session is Numbers That Matter, the CPA breakdown of the year in community associations and what to look for in the coming year. As board members and leaders of your associations, you have the job of navigating rising costs, new legal requirements, and the increasing financial complexity that we're all dealing with every day. Today's presentation is designed to give you the clarity, trends, and practical insights you need to make confident decisions for your community now and in the year ahead. We are very fortunate to be joined by two outstanding experts from WilkinGuttenplan CPAs and advisors, Joseph Chorba, CPA, CFE, and shareholder, and Jordan Burkhalter, CPA and principal. Jordan and Joe are going to walk us through how the role of the auditor has evolved, what financial trends are shaping the community association industry, and how changes like New Jersey's structural integrity law impact boards across the region. Throughout the webinar, feel free to drop your questions into the Q&A area, and we will address them during our Q&A segment at the end. With that started, we're going to get started. Joe and Jordan, the floor is yours.
Thank you, Andy. As Andy said, my name is Jordan Burkhalter. I'm with WilkinGuttenplan. I'm a principal here, and I've been with the firm 16 years. I primarily worked in the CIRA, which is the Common Interest Realty Association industry, my entire time at the firm. I'm a member of CAI New Jersey and CAI Keystone. I'm on the committee in New Jersey, Conference and Expo, and I'm going to be joining a committee in the CAI Keystone chapter in the 2026 calendar year. Joe, you want to introduce yourself?
Yeah, and I've been with the firm for almost 20, actually a little over 23 years now. I primarily work in this industry as well. I'm one of the co-practice leaders for our CIRA department. Like Jordan said, we have a concentration in New Jersey and Pennsylvania, and also in New York. We have our departments divided into two main markets. We have it's really New York, which is Manhattan, which has their own unique issues, and then there's everywhere else. So we audit probably a little over 1,000 properties between those two markets, and up and down the coast. We have a number of states. We've expanded all the way down to Virginia and the Carolinas, and we have a concentration in New Jersey and Pennsylvania, Eastern PA, with some of the large lake communities in the Poconos, all the way down through some of the suburbs and city markets of Philadelphia, surrounding areas. So we have a lot of experience in this. I've been working primarily in this industry for my entire career. I enjoy it. I love it. I love working with boards. I love working with management companies like Corner, which is they're highly respected and one of the higher quality management companies that we service. So it's a pleasure and a privilege to be with you today, and hopefully we can give you a few little things to take back to your boards to hopefully improve your financial management going forward. So it's a pleasure to be here, and I'm going to let Jordan kind of take it away and go through some of the slides here.
Great. Thanks, Joe. So this is just a brief agenda, summary of what we're going to be discussing today. We're going to go over first and foremost, what is a financial statement audit? You may hear our association needs an audit or it's required. And even if it's not required, it's typically a best practice to get a financial statement audit done. So we're going to go over what exactly is an audit. What is auditor independence? We're, as an auditor, we're required to be independent. So a lot of times, you may not know what that means. So we're going to go into some detail as to what that relates to. We're going to go over trends in the CIRA industry. As Joe was saying, we have over 1,000 clients in this industry. So we're going to see what we've seen this past year, some of the trends that we've noticed, and what we expect to see going into 2026. And we're going to take a look at what our role is and how our role as auditors have evolved over the last couple years and what we're, what value we're providing to our clients. And then lastly, we're going to touch on the New Jersey structural integrity law. And even though that, it's a law in New Jersey, it's really considered best practice for all the states, Pennsylvania included, and any state that, there may not be a law currently. So even though, you may look at it and say, oh, it's New Jersey, it doesn't affect us. It does. We're only, less than, an hour away in most cases of Pennsylvania, right across the river. So while it may not be a law now, there may be a law coming down the pipeline. And like I said, it's considered best practice. So even though it's not a law or it's not required, it's, when you're managing your board or your association, it's considered best practice. So we're going to go over that. So kicking off, what is a financial statement audit? I'm going to first start off by what it's not. A lot of the misconception is it's an internal control audit. We're auditing all the internal controls of the management company or of the board. So a financial statement is not an internal control audit. We do gain an understanding of the internal controls. We're working with right now a corner. We talk to them. We have an understanding. We know what's supposed to happen, but we don't test them. We gain an understanding of them because as we're doing our audit, we make sure that if XYZ is supposed to happen, that's happening. If we're supposed to be 2 board approvals for invoices over $5,000, we're making sure we see 2 board approvals. But again, we're not testing them. We get more comfort on our audit by doing substantive testing, which is testing of transactions. So I just wanted to clarify that it is not an internal control audit. So what is a financial statement audit? Oh, you stay on this slide. I also like to really highlight here that these are not our financial statements. A lot of times the auditor's report is attached to the financial statement. So people be like, oh, they're your financials. These are the financial statements of the board of directors, the board of trustees. They're the financial statements of the association. They're not our financial statements. Our job, we're engaged to come in and express an opinion on the financial statements, that they're free of material misstatement. We come in and our opinion is that the financial statements are reflected accurately, that they depict reality. A clean opinion doesn't mean that your financial statements are strong. It doesn't mean that you're in good financial shape. It doesn't mean you're in bad financial shape. It just means that, this is the financial position of the association. I mentioned material misstatement, keyword being material. An audit does not look at every single transaction that happened during the year. We look at material transactions. So there's certain calculations that go into that. So we look at, something that would change the mind of a reader. Why does my association need an audit? The big one there is the board of directors. You're managing the association's money. This isn't the money of, the board. It's the financial. A lot of times they hire management companies. So you have a lot of third party, so to say, involved. Having an audit ensures transparency. You get management reports, you get reports from the board. An audit ensures that whatever is supposed to be there, it's true. It validates that again the financials are free of material misstatement. It just means that they're accurately presented, and it ensures compliance with accounting standards. So as a condominium or homeowners association, you could have really there's there's a lot of different kinds, but the 2 main accounting standards we see are income tax basis accounting or GAAP. GAAP is generally accepted accounting principles. I would say that's probably 98, 99% of the audits that we see in New Jersey and Pennsylvania are in compliance with. So we ensure, and that you're picking up revenue when the performance obligation hits. We're picking up expenses as they're incurred and not when they're paid. So we're making sure that that you're in compliance with those accounting standards. And then along with the audit, when we give our clients audits, there's a management letter in there, or that's also known as a recommendation letter. As we mentioned, we do a lot of these audits. We see a lot of trends. We see a lot of best practices. So what this letter is, a lot of people think it's like a finding letter or we're doing something wrong. But that's where we look to add value to the audit. It's like, things that you may be able to do a little better, you may want to implement. So it doesn't mean necessarily that you're doing anything wrong. It's just an area that you could look to improve, as a board member to your association. Anything you want to add, Joe or so far?
No, no, I think you covered it. Knowing the roles and responsibilities for the audit is important. So there are some misconceptions there. And just one last point, the whole idea of having our independent auditors report attached to your financial statements is to give the readers comfort that they can rely on those financial statements to make their own financial decisions, whether it's a prospective buyer looking to purchase in the community, it's management or the board looking to use that information to make financial decisions. Our independent auditors report attached to your financial statements should give those readers comfort to be able to do those things.
Thanks, Joe. Okay, so real quick, we'll just go over what is auditor independence. So, there's another misconception out there is, we're hired by a management company, or we're hired by, if the association, excuse me, is in developer control, we're hired by the developer. That's not true. Independent means we have no relationship to management, developer. We are completely third party. We have no control over the financial statements. We have no management decisions. We're coming in as a clean set of eyes. We have no skin in the game, I like to say. We have no financial interest. If your association has a huge deficit or you have a huge surplus, it doesn't affect us, right? We have no risk or reward with the outcome of the financial position of the association. And that enables us to give an objective opinion because we have no skin in the game. It doesn't matter what the outcome of the financial statements are. It gives a clean, objective opinion.
Yeah,
And what
the standards require us to be truly independent with zero bias. Our job is to report the facts. What are the facts, and the financial statements would report those facts along with the footnotes to those financial statements and maybe some supplementary information. But we are truly independent in all audits, regardless of who we are hired by and what our relationship. Relationship is always a funny word. Obviously, we do have a relationship with the management companies or some of our referral sources, but it's not a financial arrangement where there is no commissions. We have nothing to financially gain by any result that in the auditor's report. We are required to follow the standards, follow the rules that govern our audit, and whatever that leads us and whatever that results in, that's what we report.
Right. And the benefit, that we just talked about what it is, but the benefit of being independent is stakeholders can rely on the financials. They know that, whatever is stated in that auditor's report, because we're an independent, because we're third party, it could be relied upon. It enhances the credibility. If we weren't independent, if you're getting a loan and the bank's looking at it, they may, take it with a grain of salt, but it enhances credibility and ultimately it drives better decision making. So the board, knowing that the financial statements are, if you have a clean opinion and it's being audited by an independent auditor, you can make better financial decisions when it comes to the association. With all that being said, what is our role in this? It's evolving. A few years ago, we've seen there was a lot of sole proprietors in the industry, and it's not a bad thing. They are able to provide good service, but with the changes in the industry, the more complexity that we're seeing and we'll get into that when we get into the trends, but we're seeing a lot more loans, a lot more special assessments. It drives that you need more expertise. So we're seeing a shift from where we saw before. There was a lot of sole proprietors. There's now larger specialized auditing firms. That does come with, like I said, you now have access to, instead of just having one partner, for example, in our New Jersey, Pennsylvania department, we have 4 partners. If you rope in New York, I think it's 7 partners we have. So we have a lot of, it's a big piece of our firm, and it gives you access to broader expertise. So, you're not just relying on one person. We have 7 people, and we all specialize in something a little, different. So if a question gets asked that we don't know, I could, flip it and check with the other 6 partners in the department.
And just to
Thanks,
add
Jeff.
to that depth, Jordan, sorry, just to add to that depth, we do, our department, while we do a large number of audits, it makes up about a third of our firm. So we have a large tax practice, we have an M&A practice, so maybe some specific transaction issues that don't come up to us every day. We can tap into some of those other resources in the firm to help us figure out maybe some of the tax consequences of certain transactions that come up in the CRA world. And on top of that, as far as quality control, right now our QC partner, our quality control partner is June Toth, who happens to also be a peer reviewer and on the peer review board of the state of New Jersey, who oversees and reviews peer reviewers. Now, peer review is a quality control process where we have other auditors or other peer reviewers looking at our audit reports and our audit work papers to make sure that we're following the standards. So we have a high quality of person on our staff that kind of helps make sure that we are following the standards and any new standards that come up. And as well as June is also I guess immediate past president of the New Jersey
Yep.
State Society of CPAs. So we do have a lot of depth here, and we're seeing a lot more of even not only in the CRA industry, but other industries, companies looking for experts in that industry to help guide them through some of the complexities that have arisen over the last couple of years. So one other thing before we get to this, there was one other point that I don't think we added it to the slide, but one other misconception that maybe should have been on prior slides. You can advance to the next slide. That's okay. But it was just one point I wanted to make on a misconception that our audits are designed to detect fraud. Now, fraud is unfortunately something that comes up from time to time, maybe more often than we would like. But one of the misconceptions is that when we issue an audit report and it's a clean opinion, it's also stating that they're free of misstatements due to fraud. Now, that's not necessarily the case. Unfortunately, some frauds do go undetected even through a financial statement audit. Financial statement audit is not specifically designed to detect fraud. Now, with that said, a lot of our procedures can and will detect fraud. It's not specifically designed to do so. So if anything that comes up related to fraud, obviously we would notify the board and management immediately. But a lot of times, just like you hear in the news, if you're watching TV, if you see fraud schemes, one of my favorite shows to watch is American Greed. It's a good documentary that talks about all these crazy fraud schemes that come up. But a lot of them are detected from whistleblowers. So that's why the role of the board in the audit is extremely important. See something, say something type of thing. If something doesn't look quite right, let us know. And we would obviously focus on things that you think may be an issue. We would focus on that as part of the audit. But I wanted to make the point that, just because it's a clean opinion as it relates to fraud doesn't always necessarily mean that we are stating that is free of fraud. Unfortunately, it could go undetected.
Joe,
That's
someone in
not
the
the case, but Jordan, if you want to.
someone in the chat asked if we performed forensic audits. So do you want to?
Oh, that's a good. Oh, okay, I missed that. I'm sorry.
Yep, that's fine.
So yeah, Jordan, when we were doing the introductions, I think it was Andy mentioned that I am a CFE. CFE does stand for Certified Fraud Examiner. In certain cases, yes, we would do some forensic type work, which is a little outside the scope of your normal financial statement audit. It would be procedure specifically designed for whatever issues you may be facing or situations. We would design some testing and some forensic work, so to speak. So yes, we do. We do that work, and yeah, and I do have the expertise and history of I've testified in front of grand juries in criminal cases and civil cases. I've been deposed, and I've worked with prosecutors to deal with certain fraud schemes that have popped up in the CRA industry. So the answer to your question is yes, but we are selective on the type and the specific situations of forensic work that we do take on.
Yep. And it's outside the scope of an audit. It would be a separate engagement
Yep,
letter
separate
and
engagement.
it'd be agreed upon procedure almost. Yep.
Okay,
Okay.
sorry for that little aside, but I
That's
guess
good.
we can get back to the historian and trusted advisor.
Yep. So going back to the how our role as auditors evolved, a couple, years ago, and we still do, we come in after year end. We look at the year in past. So, we're coming up on 2025. A lot of times we come in February, March 2026 after year end. We conduct our audit and, you get the report and it's based off of, sometimes 5, 6, 7 months ago. It's a historian. You're looking at outdated financials because, if you're getting your audits in April, May, June, that's old news. So how that's evolved is that we're no longer being viewed as the historian. We're partnering with boards. We're becoming their trusted advisor. We're at the office or virtually. We're working 365 days a year. As the boards are experiencing these projects, or maybe selling units or selling common area, and there's tax implications with that. When you're doing your budget and you're having special assessments and loans and these large multi-year projects, get your auditor involved. You don't have to wait until the audits are being done or to next year and say, then the auditor comes in and there's, 20 audit entries to fix whatever happened. As you're experiencing these complex issues, contact your auditor, say, hey, we have this upcoming loan. We're thinking about getting this line of credit to fund this project. How do you account for that? So again, we're here 365 days a year. Get us involved early, and that way your financials aren't looking completely different when the auditor comes in. And that way, we're being, like I said, we're being viewed as the trusted advisor. We're helping make these decisions. We're helping making sure it's accounted for correctly, and there's no surprises when the audits get done. So that's what a trend we're seeing.
Yeah, and we're able to maintain independence in a way that we're not making decisions for you. You call us with a question. Our job and the way we approach it is to help you understand the impact of whatever your options are. Whatever your courses of actions are. If you're doing a large project, we can help you decide what option may be best for you, but ultimately it is your decision. Our job is to help you understand the impacts of whatever decisions are on the table or options are on the table.
Yep. Okay, so before we get into trends, we just have a little summary slide, the key takeaways, everything we talked about. An audit, is more than a checklist. We're not just going through and checking off boxes. It's looking at everything. Where provides credibility, insight, and it gives the board strategic value. So they could use this audit to drive better financial decisions throughout the course of the year. Again, we're here to navigate this increasingly complex environment. And the audit is really a good tool. It could, like I said, it drives good decision making. You could see where you are at a point in time and what decisions you have to make to either maintain that or improve the financial position of the association. Any questions so far about anything we talked about before we get into trends? I figure it's a good point to just see if there were any questions.
I think
No?
we're good to
Okay.
move on, Jordan.
All right, we'll keep moving along. So what are some of the trends we're seeing in the industry? Next slide. As everyone knows, there's some inflation over the last couple years that have impacted costs for projects. If you've gotten a new reserve study recently, you'll notice, from 3 to 5 years ago, costs are much higher today than they were 3 to 5 years ago. And that impacts because, if you're funding in accordance with your study, you may think the funds will be there when you have to incur these large projects, but due to inflation, you may be short. So how are you going to make up for that shortfall? Are you going to pass a special assessment? Are you going to go out and get a loan? A lot of times they're done hand in hand, but inflation is causing some headache, especially in the replacement fund with these large projects. You may, in the past, you may have been able to do a large roofing or paving project in 1 year, but now, due to inflation and the impact, you may have to span it out in different phases. So how does that impact the financials of the association? If you're not doing it in 1 year, maybe 2 or 3 years. So we'll get into that. With higher interest rates. So with it, one of the kind of good things with inflation, you'll be earning higher investment income, interest rates on certificates of deposit, on U.S. Treasuries. You're earning more interest income or investment income. So what does that mean? That's one of the few buckets of income for a condominium or homeowners association that is considered taxable. So while, you're still ahead of the game, you're still, earning that income, it's still a good thing. But the IRS, that like I said, that's going to become taxable. And, if you, in the past, 5, 10 years ago, if your investment income was only a couple $100, a couple $1,000, you were able to offset that with deductions. So the tax expense for the association was zero, so it didn't really matter. But we're seeing some associations earn, $50,000, $60,000 if you have some settlements from developers or you're collecting special assessments and you're earning a substantial amount of investment income, and you will have to pay tax on that. So we have some more detailed slides on that in a couple slides, but just to keep that in mind. Tax rate as a condominium homeowners association, there are two different kind of forms that you could file. Not to get too technical, but there's the 1120H, which is specific to condos and HOAs, and that's at a 30% tax bracket, and you're taxed on what's considered non-exempt function income. So any income that's not in the business of being a condominium. For example, if you're renting out a clubhouse, if you are collecting laundry income. So that's income that you don't need to collect to run the association. Then there's the 1120. Larry, I'm sorry, did you have something? Okay. And then there's the 1120 form. That's your 1120 regular tax form. That's at a 21% tax rate. So right off the bat, you're like, oh, the tax rate, is less. We should always file that. But then that's what we see is some income may be taxable on one and not the other. So it may not always make sense to just go with the lower tax rate because you may actually be taxed less because there's less income that's taxable. The 1120, you're taxed on non-membership income. That's any income earned from non-members. So if you're in the example where you're renting out your clubhouse, if you're renting it to members only, that's not taxable. But if I come in and I don't live in your association and I want to rent your clubhouse and you let me, that would be taxable. So again, we have more detailed slides on that just to give you a little background. But we look at that. The one bucket of income that's taxable on both of those forms is your investment income. So just keep that in mind.
Yeah, quick question in the chat. Karen Lewis just asked if reserves are taxable or only when moving to operational. Well, just keep in mind that the only part of your reserves that are taxable are any investment income earned on your reserves, not contributions. So if you're earning any type of interest or dividends on any of your investments, that would be taxable. And that's taxable regardless of whether you're filing an 1120H or an 1120. Tax rate is different between the two, which I'm sure Jordan will get into too quickly in the next few slides. But it doesn't matter where that money is, whether it's reserves, deferred maintenance, operating. On the tax return, it's viewed as either non-membership or non-exempt function income, and that would be taxable. There was one other question from Phil. He again asking a little bit about internal controls and any changes that were made. We do an assessment like Jordan said earlier about internal controls. We do gain an understanding of internal controls and how it impacts the audits and the financial statements. We don't test those internal controls, but we can talk maybe offline if Phil, if you'd like to. If we'd like to have a conversation later on, we can talk a little bit more in detail about some of the changes that maybe Corner has implemented over the last year or so. But we'll stick to the slides here. And then Karen just had a follow-up question. So in collection in non-interest bearing, is not taxable. Not sure I understand the question, but it's really just whatever. You can look at it this way. Anything that you would have in your personal life, maybe it's a personal investment or interest-bearing an interest-bearing checking account or a savings account, anything that would be taxable to you personally, you can look at it. It'd be the same treatment on a tax return on an 1120 for a condo association. Yeah, no, and any cash that you have, any contributions, any other income, typically anything that comes from a third party, any non-unit owner, In general, there's some exceptions, but in general, for the purposes of this, because we don't have a lot of time, anything that comes from a third party in general would most likely be taxable. Anything that is comes from owners, whether it's contributions or any other types of fees, those are typically not taxable. Anything earned from a bank, like interest or investment income, that would be taxable.
Yep.
So I hope that answered that. If not, we can follow up um, outside at a later date or
At the end.
after
Yep.
this
That's fine.
presentation. So Jordan, we it is about 11:30, so we're going to go through these next slides
Yep.
pretty quickly because I know that we'll probably spend a little time on the New Jersey structural integrity and
At the end. Yep.
some
That's
of the
correct.
reserve issues that come up. I know that those are usually hot topics for boards.
And this chart, we could, again, we talked about inflation affecting costs, project costs, operating costs. This was just a chart to kind of show where we currently are with inflation and how it affected prices. But in the interest of time, we could just go to the next
Well,
slide.
and I don't know if you saw in the news recently, I think even earlier this week, the Fed did reduce interest rates a quarter point. There are some speculation. No one really knows. No one has a crystal ball. No one knows what the Fed is going to do. Obviously, it depends on how the economy does in 2026. But the expectation in the news right now is that there will be some further reductions in the Fed rate in 2026. Again, that may or may not happen, but right now, the analysts expect that there will be further reductions. Now, there's always a lag in time and how that ends up trickling down to and how that impacts inflation and then ultimately impacts the cost of operating your association and in turn also bank rates and interest rates. There is a little bit of lag, but at least there's some movement in the right direction with some rates starting to come down and hopefully normalize back to a level that we all enjoyed for many years a few years ago. So that's the most recent update on interest.
And then next slide. This was we do we call it the CIRA survey. And we kind of, since we do so many audits in this niche industry, we kind of put together data points, operating expenses of associations, replacement fund balances, a lot of key performance indicators. Our most recent one, I think, is being released today or early next week. So you could take a look at our website to see that. But one of the that we'd like to highlight here is the operating expenses. So as we said, inflation is going up. You can see the operating expenses of the associations that we audit, you can see have gone up, very similar to the graph we saw on the prior page. From 23 to 24 to 25, the expenses to run the association has gone up, and that's what we would expect to see with inflation, as we discussed. Like I said, you'll be able to look at our newest CIRA survey. It will be out next week. So if you go to our website, you can have access to that, and you could click around and see, of the similar associations in your area, size, and you could kind of take a look at that and see where you fall in that category. Okay, next slide. And this has to do with interest rates. Like as we said, the interest rates have gone up. So this is the U.S. 10-year Treasury. You can see back in 2020, 5 years ago, it was just under 1%. We've seen a lot of investments in U.S. Treasuries. It's again a very safe investment. That's the principal. You're going to get that back, so you're not putting that principal at risk, is what we like to see. And you were earning up to in 24 and 25 in between 4 and 5%. So that's a big increase from 5 years ago in the uptick of your investment income. And we're continuing to see that. So keep that in mind when you're doing when you're seeing your tax returns for 2025. You'll continue to see that higher taxable income. This is where we get into a little more detail on the tax returns. I talked about this, the 1120, as Joe said, you're taxed on non-primary rule. There's always exceptions to these rules, but you're taxed on non-membership income. So any income received from third parties as a general rule. The 1120 is a flat 21% tax rate on those taxable non-membership revenue streams. The 1120H, you're taxed on non-exempt function income. And again, that's income that you're earning that you don't need to earn to run the association. It's supplemental. It's your rental income if you rent out a unit, if you're renting out your clubhouse, if you're collecting laundry income. And we have a chart that we could show you on the next slide. But the 1128, you're taxed at a flat 30% tax rate. So it is higher, but like I said, with the buckets of income, one may be taxable on one form and not the other, and it may actually be better to file the 1128. And when we do the audits, we kind of run those both parallel and see which one
Yeah.
benefits the association most. Ultimately, it is the board's decision to what form they want to file. But again, it's just something to think about.
And in most cases, it's clear what the better form to file is. But sometimes it's not so clear. And in those situations when it's not so clear, we will talk to the board and talk it through with them to help you decide. So which form to file for that particular year and the reasons why you may want to file one over another. But this chart is a great chart. I'm not, Jordan, does this carry over onto the next
It
slide?
does.
I think it continues. So there's two slides here which kind of chart out your income and your expenses and where they fall, whether they're taxable or not, and then also what is deductible as an expense or not. So these are pretty and I think this is it.
This is the continuation. It was two
This is a
slides.
continuation, right? This is a
Yep.
continuation. So this is perfect. So again, I'm not sure if these slides will be available to you afterwards, but these two slides are helpful when it comes to analyzing or figuring out what the best tax situation is for your community.
Okay, so now again, this says New Jersey structural integrity law. In New Jersey, this is a law, so we are required in New Jersey to file it. While it's not a law in Pennsylvania and surrounding states, it is still considered best practices to follow a lot of what this law says. Because really what you're looking for, what I always say, the three main points, you have a current reserve study, and that's important because you want to make sure you have current costs. If you're looking at a study from even 5 years ago, those costs are significantly different today. You want to make sure you're funding in accordance with that study, and you want to make sure that you're using the funds for what it's intended to be. So how did this law come about? And I think we all know this. We'll just touch on this. Back in 2021 in Florida, Surfside, Florida, there was the Champlain Towers that collapsed. This law is a direct result of that collapse of the tower. So then in 2025, right, 2024, it was effective in 2025. We have the structural integrity law in New Jersey to kind of prevent this tragedy from happening here in New Jersey. And like I said, it's not in Pennsylvania, but again, it's best practice.
There was a recent amendment that was just passed in August, so I'm not sure if everybody on the call is aware of the details of that amendment. But we're going to go through that as well. We'll go through what you should be looking for in the requirements for funding reserves, as well as some of the minor changes in the amendment.
Yep. So we call it the New Jersey Structural Integrity Law, but there's also the piece that's the reserve funding requirement. So the structural integrity piece, if you fit the requirements of the law, it depends on your load-bearing system. You're considered a covered building, and you actually have to have inspections to make sure that you are, the load-bearing system is adequate. The other part of the law has to do with reserve studies, and I think you have common elements over $25,000. You're required to have a reserve study. You're required to fund in accordance with that reserve study. There was an amendment done after that now allows baseline funding. Baseline funding simply means that your reserve fund balance is never projected to go below zero. There's baseline funding, there's threshold funding, and there's full funding. As I said, baseline funding is considered acceptable. So if you fund in accordance with that study and costs are incurred, and they're what's projected in the study, you'll never go below zero. So theoretically, you should always have those funds. But as we know, not everything comes in what is, expected in the study. Go ahead, Joe. You want to say something?
I was just gonna. I don't know if we're gonna get to that. So here's the
amendment.
But before when we talk about reserve funding and baseline being acceptable, while it's accepted as the lowest minimum requirement under the law, it's not recommended. We recommend at least a 5% threshold, which gives you a little bit of cushion for maybe some items that are replaced earlier than expected, or maybe they cost more than what you had originally anticipated in the study. So while baseline funding is the minimum requirement under the law, we typically recommend somewhere between 5 and 10% threshold for your communities to create that little bit of cushion for unexpected situations. So I want to be clear on that. We're not recommending that you do baseline funding. We're just stating that under this structural integrity law for New Jersey, that's the minimum required in order to be in compliance.
Yep. So this was that amendment that Joe mentioned earlier. So in August, they had an amendment because for some associations to be in compliance with this law, it was a substantial increase in the reserve funding requirement because you may have not been funding in accordance with the study in the past. There was no law, so it created a big jump. So this amendment actually allows boards to fund 85% of baseline funding. So this you'd be funding even less. So when those expenses do come, you might not have the funds available, but this is meant, and I think you have through 2030. So it's a 5-year period that you could fund this 85%. But just know that if you do that, there are additional disclosures that have to be made to sellers and buyers. So you have to let them know, like, hey, we're funding this 85% of baseline. So it's an additional disclosure to those parties because again, we don't recommend baseline. So now you're funding even less than baseline. But I think this was intended to, if you have to gradually increase the reserve funding in your budgets, you might not have been able to do the jump to baseline or 5% threshold in 1 year. This allows you to spread that increase over 5 years to get to the minimum funding requirement of the study. Anything else on that, Joe? But I think that's really
No, I think you covered it.
Yep.
There was one other question about whether or not PA requires a reserve study. Now, Jordan, correct me if I'm wrong.
No, they do not
The
require a reserve
PA,
study. And that's why we say this is best practice. So when we
but
conduct
their
our
documents
audits,
may require it though.
yes.
Yeah.
But when we do the audits for our Pennsylvania associations in our management letter, if we see that there's an old study or you're not funding in accordance with it, that's when we give a letter of recommendation saying, hey, your study's 5 years old, you should get it updated. So, where we look to add value is to make sure you have a current study and you're funding in accordance. But right, your bylaws may require it, but there's no the law that I'm aware of currently.
And before this structural integrity law was passed, Pennsylvania was similar to New Jersey, where there was no legal or law requiring a study, but the documents, your governing documents for your association typically do require that you have a reserve fund set up. And best practice, we go by best practice of having a study done and funding in accordance with that study to make sure that you're in compliance with your governing documents. But to answer your question, there's no law that's requiring you to have a study done.
Yeah, and just before we move on to the questions and answers of our presentation, in the past, you may have gotten a reserve study from an engineer. You may have not agreed with, the elements in there. They may not have agreed with the life expectancy or the cost, and boards would have just had it, and then they just ignored it or funded what they wanted. This law really requires you, when you get this study, to really look at it. If you're going to be doing concrete replacement in phases every 3 to 5 years, they may have all the sidewalks replaced in 1 year. You can really work with your engineer to kind of, get a realistic picture of how your association intends to incur these expenses. If you do it in phases or if you have courts or different, areas, make sure your study puts that in, and that will help with the funding requirement, because if you're not going to replace it all in 1 year, that spreads out that cost. So you really need to look at your study, work with your engineer, see how they develop these, expectations or their estimates, and work with them, and they could modify it and make sure it, depicts reality. Right, Joe?
Yeah, you got it. And then we have just a couple of FAQs that have been coming up over the last
that we've
6
heard.
months
So
to a year or two. So
can you go back to
I
that?
think we've covered some of these, but Jordan, I don't know if
Yeah.
you want to
Each
touch
time
on
our
some of the ones
association
we
pays the
haven't
updated reserve study,
covered
does the
yet.
new law allow us to take advantage of the 85%? So this 85% funding amendment that we talked about is a one-time alternative, and it goes through 2030. So we don't expect them to, continue this in perpetuity. It's just allowing you to get caught up to where you need to be. So it's once 20, you have this 5-year period, and that's going to be it with that. if we opt in for the 85% funding option, will it increase our funding level? And the answer to that is absolutely yes. So if you're not even funding the bare minimum to get to the zero baseline, once you go to fund in accordance, your funding in the subsequent years will be increased to make up for the shortfall in the years that you did the 85% baseline. So while it, you may be able to keep fees down in a year or two, just know that, you're going to have to take into account the increases in future years. Next slide, please. Do we have to fund that way for the full 5 years? So no, you don't. If you're taking advantage of this amendment and funding 85%, you could do it in 1 year, like I said, to kind of gradually get there, and then you could go to the baseline or 5% threshold in the next year. So you don't have to do it that whole 5-year period. You could do it for a year or two, whatever you need to do to get there. If a reserved asset requires replacement, can you go back? Actually, I have it here. If a reserve asset requires replacement before the projected useful life expires, or if the cost of the repair exceeds the amount projected, can a board still borrow or special assess to fund reserves? And the answer to that is yes. The original amended law do not prohibit a board from borrowing or instituting a special assessment. With that in mind, you want to make sure that you're passing the assessment in compliance with your governing documents. Always run it by your attorney to make sure if you have to get the vote of the unit owners or if the board, you want to make sure you're in compliance. But the law itself does not prohibit you from passing a special assessment or using it.
Yep. All right. So before we move on to this, I mean, is there any other questions about reserves or the structural integrity bill for New Jersey?
Nothing in the chat right now, Joe, so we'll just keep moving and we
You
probably
got
have
it.
some.
Awesome. All right. So there's a couple other bills that are have been proposed. So this it's funny how things move and how fast things change. This slide, since we put this together, and we've done this presentation for a few different groups, but I believe that there are even some further changes or some amendments that may kind of not retract but amend some of the proposed changes to this bill. But it does impact associations and assessments and special assessments for all affordable units. So I'm not going to spend too much time on this because this is a fast moving, and this is a bill that has not been implemented yet, or it hasn't been passed into law just yet, these changes. But just keep an eye on them. And, one of the benefits of CAI for both New Jersey and Pennsylvania is the activity and efforts of the LAC and PAC committees. And I don't think everybody who lives in communities in New Jersey, especially and even Pennsylvania, fully appreciate the efforts of the LAC committee. And there's a lot of bills that are proposed that some are directly impacted. Some are like the New Jersey Structural Integrity Bill. Obviously, that's directly impacts and geared towards associations. But there's a lot of laws and bills that were not specifically intended to impact the condos or HOAs. Maybe they were for some other reason or some other industry, but the way they're worded may indirectly impact people that live in communities. So the New Jersey LAC and PAC, or really the LAC committee, reviews all of those bills to make sure that communities and people who live in these communities have a voice, and that we can challenge some of the wording and make changes to some of the wording in bills so that either it lessens the impact or it removes the impact, or at least it's a more favorable outcome in some of these laws. So this is one in particular that the LAC is actively defending the rights and voice of community owners. So stay tuned for this one. We don't know exactly where it's going to end up, but there are some proposed changes that are out there that we hope will have a favorable outcome. You can see the last point that LAC is fighting that. So, okay, Jordan, you can
Yep.
pick this back
So
up.
this is kind of this is our last slide. It's just what we've seen. We talked about the trends we've seen in the industry. So what are the impacts of the financial statements of your condos and HOAs? We've seen a lot larger, and I talked about this before, projects are now spanning multiple years. And that could be a result of the rising costs for labor, materials, the engineer costs to oversee that project. So instead of having it all happen in 1 year, it's happening 2, 3, 5 years. And that makes it a lot more complicated for accounting because you have to pick up those expenses when the work is done, not when it's paid. So you have to make sure that you're accounting for that correctly. A lot of times there's retainage involved, so you want to make sure that's being accounted for correctly. So that's what we're seeing with regards to the projects. Because these projects are costing more, you might not have the funds readily available. We're seeing a lot of loans or lines of credit to maybe get the cash in right away and fund those projects to get them done. But then, like I said, we're seeing a corresponding special assessment passed to pay back that loan to fund the project. We've seen very creative special assessments. We've seen some that are all within 1 year, payable over 12 months. But then we see some that are, they may be 5, 10, 20-year payment options to pay back the loan. So when you have those multiple year special assessments, we've seen different payment options. If you pay it all in one, day one, you pay one amount. But if you're paying over 5 years, you're paying a little interest piece because you're paying interest on the loan or line of credit. So you get maybe like a little discount if you pay it all up front. But as you pay it over a year, there's the interest factor in there. So that you get into deferred finance charges and how you recognize that. So you really start complicating, or you get into a more complex accounting environment there. When you have the multiple years, you have to take into account the time value of money. A dollar today has a very different value than a dollar in 5 years from now. So there's that piece of it. So it's not just, you take it by the number of units, multiply it by 5 years, there's your receivable. You have that time value of money piece that you have to factor into that. So it just really complicates the financial statements of the association. And that's where, like I said before, look to your management company, look to your auditors. We're there to help and kind of help making sure that you're recording this correctly, and that, again, you don't want to be surprised when you get your audit done and you think you have X amount of dollars, but you really only have Y. You want to make sure that they're accurate throughout the year, and that drives better decision making by the board. No one likes surprises. If you think you have it and you actually have less, because again, it's going to impact the financials of the association. Anything else you want to cover there, Joe?
No, I think that's it. I think one individual had asked if we could share our contact information. So I don't know if we have it on the screen. I thought we would have it, but
It was.
That will be on the screen. Absolutely. And I do have some questions for you guys that
oh, sure.
we're going to
Oh, there
ask.
you go. I thought we did have it. So we have our contact information if you want to take a quick screenshot. But are there
So,
questions, Andy?
yeah, so a question for you from the audience. With rising project costs, what financial indicators should boards be paying closest attention to in the next 12 months?
With yeah. So here's where it's really important to engage your professionals, engineers and accountants. While what's going on in the world and in the economy does impact it, it doesn't always give you a clear indication on how that's going to impact your specific situation or your association, or it does have an impact, but it may not always give you an accurate reflection of how that's going to impact the cost for your particular project. So it's important to always have your reserve studies updated frequently, so you're working on the most recent information, especially for the cost. And when we were working with rising interest and rising costs that were in some cases rising quite sharply in certain years, we were actually recommending that you update your study and have your engineer do an assessment even a little bit more frequently than 5 years in some cases, because I think I said earlier, the rise or fall in interest rates sometimes have a little bit of a lag on how that trickles down and impacts you as an association. So you may see a decrease in interest rates from the Fed announced earlier this week. Well, how that impacts you may not see that impact for 6, 8, 12 months, even maybe even longer at that point, by the time that all works itself out through the economy down to your specific costs. So I think it's I don't know if there's necessarily some indicators that you can look at maybe in the news or in the world or in the economy. I think it's more important to engage your professionals so that you're working off of the most recent information available.
Great. Thanks, Joe. Another question, which kind of goes along with that, and it's an interesting one that shame we don't have a reserve specialist on here. But many reserve studies appear to significantly overstate future expenses. Competitive bidding shows major differences from expectations and actuals. In turn, that can inflate the zero baseline of contributions required and put an increased burden on resident members of the association. How can this issue be addressed and overcome in an equitable manner?
Jordan, do you want to take this one or you want me?
I was going to say, I really think that's when working with your
Yeah.
engineers. If you're looking at what they put in the study as what they anticipate the project is going to cost, and let's say you had it done a couple years ago, that's when you could be like, hey, we had this done 2 years ago. It cost 50,000. You have 150,000. Like, what do you have in there? So really obtaining an understanding of what they're basing that off of. Sometimes they build in project oversight with the cost. If you're having a large project, sometimes you hire an engineer to oversee it. They're looking at the AIAs to make sure that the work was actually done. So you really want to work with your engineer and understand how they're coming up with those expectations. If you have a differing of opinion, talk to them, show them, this is what you had done. Maybe there were cost increases that you don't know about. Maybe they just, overstated it, and then they could update that number. If you go back to them and you discuss it with them, and they're like, "Oh yeah, we didn't know that," they could actually reduce it and would then reduce your funding. Or they may say, this is why we have it here, and it stays the same. But at least you understand why they have what they have in the study.
No one knows your community better than you
Yep.
do as board and people who live there day after day. So even though these engineers are experts, I agree with Jordan 100% that you need to work with them if there's um, adjustments that can and should be made. You're welcome to do that. Again, that's your report. Work with your engineers to try to figure out a way that's comfortable in the contributions. And with that said, once you work out all of those, the future cost and maybe the useful lives and the replacement schedule, um, check with your other professionals like your accountants and your management company to help you determine the best way to implement those contributions. So, there may be creative ways and creative schedules or plans that you can come up with that'll meet your needs in the short term and the long term, and possibly lessen the blow of large increases in your budget due to increases in replacement contributions.
Cool. Thanks, guys. Got one last question for you, and
Sure.
thanks everybody for joining us, and we appreciate everybody's time. What are best practices for Pennsylvania associations to demonstrate financial transparency and fiduciary responsibility without a legal audit requirement? And what risks do associations face when they choose not to conduct regular audit?
Hmm.
It's a good question. So even like we said, best in order to increase your transparency, even though it's not required, have an audit done. It shows your unit owners, it shows the other board members full transparency because you have that independent auditor coming in and testing all of the financial statements. They're expressing the opinion. So that is the best thing you could do. I know a lot of times we see compilations or reviews, while that could be done by a CPA firm. The best course of action you could take is having an audit done because that requires independence. It provides an opinion on the financial statements. So again, even though it's not required in Pennsylvania, we are seeing more and more associations look to have audits because they want that transparency. They don't want to have unit owners or new buyers come in and when they ask for an audit, because they may be moving from a state that did require it or have more, it's more of a mainstream thing to have done. They're asking for the audit, and to be able to have that, it's just the best thing that you could do.
Yep.
Go ahead,
That's
Joe.
great. And I got, what, I actually have one more question that'll really help
Sure.
to wrap this up. For both of you, if you could give boards one piece of advice to improve financial resilience long term, what would
Hmm.
it be?
You want to
Jordan?
go first to me? My
Yeah, I mean,
mine.
I can go. I think it goes, it kind of ties into the last
Yep.
question. I mean, definitely transparency, sharing information, um, making sure that you're working off the most recent information that you possibly can. So, there's some, I'll use New York, for example, where New York is not required to have reserve studies. We often recommend that they develop even a 5 or a 10-year capital plan to make sure that they have information available to them to make decisions and engage your professionals. I see oftentimes that there's boards that just don't rely on their professionals enough, as much as they should. While even you may have board members that may have financial backgrounds or may have a professional background in dealing with finances or dealing with property management. Oftentimes those individuals just simply don't have the experience in this industry and knowing the ins and outs of this industry. While they're valued and they bring a lot of value to the board and property management, they don't necessarily always have the industry experience needed to properly manage these associations. So engage your professionals, update your information, and share that information as much as possible to the extent you can with your owners, to provide that transparency.
I agree, and I'll just add to that. When you're doing your reporting and you're looking at your budgets, be realistic. The worst thing that you could do
Good
is
point.
if you have all of this good data, you have a reserve study, you have your professionals, and then you go around and you don't listen to it, and you do that just to not raise maintenance fees. That makes our skin crawl, right? You want to be realistic. You
Good
want to
point.
be you want to fund in accordance. You want to, and if you increase your fees and maybe it's more than you want it, maybe it's 8-10%, but you want to make sure you have the funds available because it's a big hole to dig out of if you're not funding your reserves
Yep.
adequately, you're not maintaining your association the way you should be. So you really want to use the professionals, you want to use the current data you have, and you want to be realistic in your budgeting and running of the association.
Yep. You got it.
That's fantastic. So we're going to wrap it up. So thank you, Joe and Jordan, so much for an incredibly informative and timely presentation. We really appreciate your participation. Thank you as well to everyone who joined us today for being part of this version and this webinar in the Guided by Corner webinar series. We hope today's discussion gave you a clear understanding of the financial landscape that associations are facing. They're complex issues, but with the right advisors and the right information, boards will be better equipped to make sound, confident, and forward-looking decisions. So if you'd like to continue the conversation or ask any follow-up questions or explore how these topics apply directly to your community, please don't hesitate to reach out to any of us. Our contact information is on the screen. And on behalf of Corner Property Management and the team at WilkinGuttenplan, thank you again for spending part of your day with us. I hope you have a great afternoon. We all wish you an amazing holiday season, and we look forward to seeing everybody on our next webinar. Thank you again, and hope everybody has a great day.
Thank you for having us.
All right.